One of the premier direct-to-consumer retail companies of a generation is hitting the public markets. Warby Parker has 60% gross margins, has raised more than $500 million in private markets. So they're doing a direct listing, and in today's video, we're going to talk about not only the bull and the bear case for the equity, but why I was shocked by the competition that they face.
I'm Hannah, this is Aaron, and you're watching the Piper Rundown. We analyze business and culture to help you win.
We want to help you win.
We do. And so does JetStore, who is our sponsor for today. JetStore has been providing affordable, reliable, and easy to manage data storage and cloud solutions to over 4,000 customers worldwide for more than 26 years. That's a long time. It's longer than I've been alive. They know what they're doing when it comes to your data storage and cloud management. Stick around until later in the video so you can hear more about what JetStore can help you with.
Speaking of wins, in the next month, Warby Parker investors, early employees, founders are expecting a relatively large win when the company hits public markets via a direct listing and achieving a valuation north of $3 billion. Now, as a quick reminder, direct listings are not a conventional IPO process, nor are they the SPAC du jour of the last 2 years. A direct listing is when the shares of a company are traded publicly without the same lockup period associated with the public offering. The reason that that lockup period is not in place is because the company is not raising capital from public markets as a part of that offering. The companies in the past that have taken this route are some very strong ones, including Palantir, Spotify, and Coinbase. Felix Gray has raised over $530 million in private markets. So they do.
Warby Parker has raised.
What did I just say?
Felix Gray.
Felix Gray.
Already getting to the comps, Aaron.
Already getting to the comps.
Damn, you were chomping at the bit.
Sheesh. You're going to have to correct me because that's probably not going to be the last time that happens. They've raised more than $530 million in private markets. So despite the fact that they are racking up some substantial losses on a year-to-year basis, they do expect to have enough on their balance sheet. And once you're a public company, it's easier to raise debt. It's easier to find financing in other ways, shapes, and forms. But they believe that they have the runway to be able to continue to operate without raising markets from the public. Some quick information about Warby Parker. First of all, they sell glasses.
They do sell
Similar
glasses.
to Felix Gray, I have previously worn both Warby Parker and Felix Gray specs on my face, and don't feel particularly strongly about the qualities of one versus the other. I'm probably not particularly discerning, but that's just the truth. It was founded in out of New York, where the founders basically asked a simple question: why am I going into Lens Crafters, Pearl Vision, some of these other places, and spending multiple hundreds of dollars for a bit of plastic, a small bit of metal, and a shaped piece of glass or composite material? There has to be a less expensive way to produce these shades, produce these glasses, and that's exactly what they did. Their flagship product started off at just $95 for a pair of glasses, slate upcharge with particular sets of lenses. And this also came at an age when it was founded back in 2010, when only 2% of glass sales happened online. It was very conventional. At least for me, you'd go into like one of the big malls in one of the corners.
Try on 17 different frames.
Try on a couple different frames. They're going to turn around to you in like an hour or something. You walk around the mall, maybe get an Annie Ann's pretzel, and end up with your new specs. Now, today, they in their business accounts for more than 60% of sales happen online. They're starting to open some stores, you get fittings, other stuff like that, but more than 60% online. A absolutely transformative, perfectly indicative company of the direct-to-consumer retail megatrend that has swept through all of the business world. Some other interesting facts: because of those low prices, because of the convenience of getting sent multiple shades, I keep calling them shades. Multiple glasses online, direct to your home, try on a few, send the rest back. A net promoter score of 83, which is pretty darn strong. Similarly, they have a 60% gross margin on those glasses. So despite the fact they brought the cost of a new pair of glasses down, they are still maintaining a relatively healthy core margin to the business, although they're spending a lot on sales and marketing to try and get the word out and to grow the brand. And it raises an interesting question. When you put together the 60% gross, that's not net, gross margins, with the fact that they are losing some money, they do have money on the balance sheet, why they don't need to raise anything in their direct listing. In 2019, $270 million worth of revenue, $393 million in 2020, and in just the first 6 months of 2021, $270 million. So they have effectively doubled their effective annual revenue in a 2-year window. Pretty darn strong for a direct consumer retail company. That revenue growth has come with losses. 2019, $57 million worth of losses. 2020, $55 million worth of losses. And in the first 6 months of 2021, $20 million worth of losses. So basically still on pace for a slightly reduced loss, but this is a loss-making enterprise. Later in the video, we're going to talk about exactly why that's possible.
But now we're moving on to comps. In order to better understand any company and decide whether or not you should invest in said company, it's helpful to look at the business landscape surrounding it and some comparable companies and competitors. So Aaron, tell us about the comps. You already name dropped one.
I already mentioned Felix Gray, still a privately traded company, not raising quite as much as Warby Parker. They are the fast follower. You got Lyft and Uber. You got all these different startups where once a little arena is identified as an area of opportunity, we just did ForgeRock competing with a company like Okta. They're a little bit later on in the process. There's always going to be venture capitalists that say, man, I didn't get into that, so who's the competitor that I can place my bet on if they have decent operational execution? Felix Gray represents that. At the same time, there are the large incumbents. Luxottica, an Italian company that owns Pearle Vision, has a shockingly high market cap.
Really?
Yes. What do you think it is?
I have no idea. In the glasses space?
Glasses.
Pearle Vision. I couldn't even guess.
I was blown away by this. $84 billion.
What? What?
Their competitor out of France, Essilor, a French eyeglass company, has a market cap of 71 billion euros.
What?
Crazy.
How bad is their eyesight over there?
Pretty darn bad. But here's the interesting thing to consider. Number one, LTV of a customer. Someone buys a pair of glasses. I don't know like how long your last pair of glasses lasted you. My last pair of glasses lasted me maybe 3 years, and then it's time to update my prescription. You know, the frame's getting wonky or whatever.
Yeah.
So before the advent of Warby Parker and Felix Gray, I would have just continued coming back to LensCrafters. As a kid, that's where we kept coming back to every 2 frickin' years.
Right.
And so the LTV of these products, despite the fact they're only, maybe now $95 or $150, you're stacking that up over a long lifetime. Similarly, as people get more disposable income, whether it's shades, whether it's other, now there's the expanding blue light blocking lenses, the opportunity to have an exceptionally high lifetime value for these customers is very high. Yeah. And there's just a lot of people that wear glasses. There's a lot of people that don't have 20/20 vision.
Yeah.
I was blown away by that market cap, and everything preceding finding those numbers left me very cold on this equity. Everything before that, I was very, I think I'm falling more on the bear case here. But if you dig into the revenue numbers of both of those brands, pretty darn strong. And when you consider a 60% gross margin and the fact that they've been able to raise all that money, to me what that indicates is we still have the inside track to be that relevant of a product provider for the glasses space. And if we can gobble up some more of the market cap of both of those players who will still be relevant, who are still building their own e-commerce channels, but do not have the brand equity with younger demos that Felix Gray and Warby Parker have earned, there's a lot of upside for something like this. If it's, probably closer to a $4 billion valuation, I would guess, by the time this actually hits the public markets. That clarified a lot for me.
Wow, that's fascinating. Let's move on to the meme factor. If you're unfamiliar with the meme factor, is where Aaron and I rank the memeability of a company on a scale from 1 to 5. 3 being completely neutral, not memeable at all. 5 is hella positive memes, think Elon Musk and Tesla. and one is negative memes. So it may be a good business, but it has some negative storylines surrounding it. Aaron, what is your meme factor?
Once again, I was coming in way colder as I thought about it more. This is really one of the vanguard direct-to-consumer companies that isn't just broken. Like when Casper Mattress came to public markets, it was basically revealed that they have no real differentiation in their mattresses. They buy it from the same manufacturer as every other mattress company.
Right.
And their margins are really brutally painful. And the lifetime value isn't there. You buy a mattress, you sleep on that mattress for a substantially longer time than you keep a pair of glasses. You might lose your pair of glasses, you're not going to lose your mattress, right? So Warby Parker is really one of the vanguard direct-to-consumer retail companies. We've covered Figs, which did really well in their public offering. We did Honest Company, which didn't do so well, but they have much more challenging margins and business models and costs. Mm-hmm. And forthcoming, we have Allbirds and some of these other companies. I would rather own Warby Parker than just about every company on this kind of cohort of direct-to-consumer companies other than Figs. I love Figs.
Yeah.
And a lot of companies have sprung up, either Felix Gray as a copier in the lenses, but just in general, we're the Warby Parker of X. It was literally like, that's how it was discussed with all these direct-to-consumer companies.
Brand equity is no joke with Warby Parker.
So I'm giving it a 3.8. That's higher than I expected for glasses. And coming into this, 3.8.
Yeah. I'll go 3.9. It's not quite in the 4s just because there's only so much you can do with glasses memeability wise, but Warby Parker, I feel like I've been a fan of the brand for so long, and I guess now we can move into the bull and the bear case, but before that, let's hear more about JetStore, our sponsor for today. JetStore offers storage systems for private cloud hosting, video surveillance, Internet of Things, AI, machine learning, edge computing, data archiving, HPC, media production, medical imaging, and flight simulations. That's crazy. JetStore provides storage space for so much stuff. If you need help with your data storage, please contact JetStore. You can find out more at jetstore.com. On to the bull and the bear case.
So we've really hit on two of them already. There's real brand equity here. Real differentiated brand loyalty evidenced by that NPS score. Similarly, this is a very large market. This is a large market with a fundamentally strong gross margin underpinning it. And it is only growing. Like there are people, so we talked about the blue light blocking glasses, but now there's like the golden tinted glasses. It's similar to the blue light stuff, but it's more centered around sleep. It's like red tinted or something. But there's like all these trendy stuff that's coming up in the glasses space. A lot of people just wear glasses because they like the look of them, not necessarily for functionality. And I've noticed that anytime, literally, I can think of 5 specific examples of when this has happened. Anytime I compliment someone on their glasses, I say, "Oh, I really like your glasses. Are those Warby Parker?" And the answer is always yes. So the product is noticeable and distinct. And I don't know, I'm pretty bullish on Warby Parker in general. And the other side of it is there's this other kind of reimagination of medicine generally. And we've talked a little bit about companies like Hims, like Roan Health, that are not focused on eyesight. They're focused on other supplements and medications that people want to kind of get in a discreet way. They don't want to travel into a doctor's office to just get a prescription that they clearly need. I think there's a future where you're interacting with someone to update. Like I've gone to the optometrist, I don't know how many times for like an updated prescription, when other times I'm like, literally my eyes have not changed that substantially. I get that you guys want to collect your big check from the insurance company to get me in there. I just need a fresh set of glasses. And it's unfathomable to me that at some point in the future there won't be a telemedicine solution where you check in really quickly, you just confirm, like it's not like you're asking for like, you know, OxyContin or something. I'm asking for the same pair of glasses that have worked for me. And if I want to spend my money on that, I should have the sovereignty with which to do so. So the future where I think it's even possible that in some way, shape, or form there's a partnership or candidly even a merger between one of those telemedicine companies and a company like Warby Parker and continued lifetime values go up, continued brand affinity goes up.
Yeah.
Convenience is baked into the model in a way that legacy medical providers just are incapable of.
Yep.
Makes me super bullish. On the bear side, they are purporting that one of their solutions moving forward is conventional retail. So they have 145 stores. They're going to expand that number substantially. Now you could see how that turns into drop into our eye clinic, the same way CVS is like, don't go to the doctor and fulfill your prescription here. Come to us and we'll give you the checkup or the booster shot or whatever it is that you need. So that's simultaneously compelling, but risky when you're putting those type of leases and stuff on your balance sheet.
Right.
And then further, if you can't get your mind around the fact that this is a loss-making company in the short term, they are going to continue to spend to acquire customers because of the underlying core numbers that they see on the balance sheet, it's going to scare certain people off. For certain people, that's just not their cup of tea, and I understand that.
Yeah, totally understand that. Well, that's Rundown. Thank you so much for watching. If you have stuck around this long, we really appreciate you and your viewership. You might know that we are on pace to hit 10,000 subscribers. That's our goal by the end of the year anyway, and things are looking up. So if you could share and like and subscribe, that would be very helpful. We would like to read a comment from one of our viewers. Crazy Kuwaiti commented on our Dole IPO video. First video I see for you guys, and you got me hooked. Well, thank you. We love to hear that.
Shout out to the Crazy Kuwaiti.
That's one of the best things that I've read all week. Well, I guess it is Monday.
You don't read much, do you?
Come on, I was complimenting our commenter, but that's a Rundown. Thanks for watching.